All right, I'm back and talking to Rick, my Arizona mortgage broker here, and today we're going to talk about down payments.
All right.
What in the world is the necessity of a down payment? How does that affect anything? Can you explain all that?
Oh, you bet. So, down payment is what assures the lender that they're going to be safe inside of that loan that they're lending, that investment for the lender, and it ensures that the borrower can, has the wherewithal, has some funds to put down and put some skin in the game, so to speak. So,
Okay.
down payment is a very important part of the home buying and the loan qualification process.
Okay. So is there a minimum down payment, or how do we figure out what that amount needs to be?
Sure. So it depends on the kind of loan. So you've got a few different loan types. If you're a veteran and buying with your VA benefit, you can go zero down if you have your full benefit.
Okay.
On an FHA loan, the minimum down payment would be 3.5%.
Okay.
And then on a conventional loan, the minimum down payment is going to be, typically it's going to be 5%, in some cases 3% for first time buyers, but generally we're looking at 5% down.
Okay. What does a loan to value mean? I hear that term, loan to value. How does that relate to my down payment and my monthly payment?
Sure. So down payment, let's just be simple. Say you're buying a place for $100,000 and you put 5% down. That means your loan to value is going to be 95%. So
Okay.
you're taking care of 5% of that with the down payment, and then you'd be at a 95% loan to value. So the way it works on a conventional loan, for example, that's where you may want to increase your down payment, and it would affect and improve your payment. So on a conventional loan, if you put less than 20% down, then you're going to have mortgage insurance.
Okay.
So mortgage insurance is something that the lender requires because it's a protection to them. If something happens and the loan defaults, then that covers them to make sure they're going to be whole on the loan after they have to sell it and all that.
Okay,
kind of
so
stuff.
mortgage insurance is basically put in there when the down payment isn't quite high enough for the comfort of the lender to make sure there's a way for them to be okay on the loan, no matter
Correct.
what happens.
Sure, yeah. And
Okay.
so with anything above, or I should say anything above 80% loan to value or less than 20% down payment would require mortgage insurance on a conventional loan. And the way that works is every 5% more you put down, then the mortgage insurance gets lower until it would go away at 20% down. So
Okay.
at 5%, you have a certain factor, a higher factor for the mortgage insurance.
Right.
And then at 10%, it gets lower, at 15%, and then 20% it would go away.
Okay, let's say I could only come up with 5% down, and I did get a loan, and I moved into the house, and a year later, the values have gone up, and my loan now represents only 80% of the current value. Is there a way to adjust that insurance, or is that kind of locked into the whole paperwork?
It may be possible. So at that point, you would have to check in with your loan servicer and say, hey, values have increased. Now, generally, they're probably going to want you to pay on that mortgage insurance for at least a couple years.
I see.
So at least a couple years, and then you've paid it down some and values have gone up. You could approach your loan servicer and maybe see, hey, would you allow for an appraisal to get rid of the mortgage insurance?
Okay.
But as you pay it down, by law, that mortgage insurance would have to go away once you hit 78% of the original value of the home.
All right, so it's going to go away anyway with making good payments eventually?
Eventually.
Let's say I'm looking at all these different mortgages and down payments and stuff. Do you have any guidance for how I should figure out what I need to do?
A lot will just depend on what kind of funds you have available, right?
Okay.
So a lot of times people are, they want to, do whatever they have to do to get rid of that mortgage insurance. So they'll deplete all their money just to put 20% down.
Right.
They get in the home. A couple years later, all of a sudden they're needing some of that money back.
Right.
So what you really want to consider is, when I close on this loan, what's my savings situation going to look like at that point? And you buy a new home, you move in. There's things you maybe need to fix. There's things you want to buy. Something changes with work or with health. You just always want to have some of that money with you. It's always harder to go back and get it once you've put it all into a down payment.
Right.
So you want to think about your whole financial picture when you're thinking about how much money to part with on a down payment.
Yeah. All right, what kind of funds can I use for down payment?
Good question. So funds can really come from just about any place that can be sourced. So they can come from savings, they can come from checking, from investments, stocks, retirement. There's in any place that you can source the funds. So cash is a no-no, right? So you have $10,000 sitting in a drawer, and all of a sudden you deposit it, right as you're in the transaction. Well, where'd that money come from? It's not going to be usable. So just about anything you can source and anything other than cash can be used for the down payment.
Does that include family members helping you out?
Yeah, and we see that a lot too. So you can get gifts for the entire down payment, typically on any loan type. So it's just a simple gift letter from a family member, and that can be all or part of your down payment.
Okay. Very good. Well, thanks for answering all those questions about down payments, Rick.
You bet.